Have you ever logged into your brokerage account and, the financial news is just practically shouting that the major indexes are hitting all-time highs?
Right, they're celebrating.
Exactly, but then you look at your own portfolio and it is just bleeding red, like totally down.
Oh, yeah. It's an incredibly frustrating experience.
It really is. You sit there looking at the screen thinking, well, if the broader market is doing so phenomenally well, why are my specific holdings taking such a hit?
Right, it feels like a glitch.
Yeah. Well, today we are going to look at a master synthesis of market data that finally explains this exact paradox. Our mission for this deep dive is to decode a really specific allocator-grade view of the market state for today, June 3, 2026.
And I got to say, the source material driving our discussion today is frankly remarkable. We're looking at a master document that aggregates signals from 14 distinct AI models.
14. That's a lot of computing power.
It's massive. We're talking everything from Gemini and Claude to specialized financial models, like FinViz and DeepSeek. They essentially ingested a real-time snapshot of global financial dashboards, options flows, macro indicators.
Remember heavy lifting.
Right. And they synthesized all that raw data into one cohesive narrative.
And the thing that immediately grabbed my attention was the unanimity of it all. Like all 14 of those distinct models, looking at oceans of data entirely independently, they all converged on the exact same undeniable conclusion.
Which is pretty rare, right?
Yeah, super rare. They found this massive structural paradox. The surface of the market looks like an absolute victory lap, but underneath, the warning sirens are blaring at full volume. I mean, the foundation is cracking.
Yeah, completely.
So we are going to explore why that disconnect happens, and more importantly, we're going to trace exactly what the deepest pockets like, the institutional smart money, what they are doing right now to prepare for what they clearly see coming.
To really grasp the scale of this paradox, though, we have to kind of separate the headline index numbers from the actual underlying plumbing of the stock market.
Right.
Because headline numbers, well, they're inherently designed to make investors feel comfortable. They're capitalization weighted, which just means they heavily skew toward a handful of the biggest winners.
Yeah, and I see that clearly on the top of the dashboard here. The S&P 500 is riding incredibly high today, hovering right around 7540. And the SPY ETF and the E-mini futures, the ES, they're basically mirroring that peak, sitting at 754.24 and 7544.
Exactly.
If you just read those top-line numbers, you would safely assume, oh, we're in the middle of a raging, unstoppable bull market. Everything feels pristine.
Right, which makes the market internals so jarring. What's fascinating here is that market internals measure the actual physical data of how many individual stocks are participating in that upward movement.
Okay.
When we pull back the curtain on those metrics, the reality is that while the index is flat or ticking up, the internal breadth of the market is just completely collapsing.
So okay, let's unpack this. It's like looking at a beautifully painted house, right? But when you go into the basement, the foundation is completely rotting away.
That's a great way to put it.
Look at the NYSE TEAK, for example.
Yeah.
This is the actual second-by-second tape of whether people are hitting the buy or sell button across the entire exchange.
Yeah.
It is buried in the red. It's sitting near negative 496. People are quietly rushing for the exits on a massive scale.
And the advancing versus declining issues, the ADD metric, confirms that exact same stalling momentum. It's deeply negative. We're looking at decliners outpacing advancers by negative 1381.
Wow.
But those are just the immediate intraday indicators. The models point out that the structural damage playing out over weeks and months is much more revealing.
Yeah, the new highs versus new lows stat is what really cemented that for me.
Oh, that one is brutal.
It is. The New York Stock Exchange new lows just exploded. They are up over 66%, pushing up to 1718 individual stocks. Meanwhile, the companies making new highs dropped significantly, down nearly 36% to just 842.
It's staggering.
You literally have double the amount of companies hitting absolute rock bottom compared to those making new highs, all while the index itself sits near an all-time peak.
Right, and we can see that bleeding heavily across specific traditionally resilient sectors too. Small caps, the IWM, they're taking a heavy hit today, down about 1.37% to 287.67.
Yeah.
And the software sector, IGV, is just taking a massive beating. It's down 4.33% today alone, sitting at 100.20.
Ouch.
Yeah. The models synthesize all of this data into a really specific diagnosis. They call it a late cycle narrow leadership rally. It's distribution, not accumulation.
Okay, meaning what exactly
Meaning
there?
the index is being propped up, right?
Yeah.
Held aloft by a few giant mega cap stocks, while the vast majority of the broader market just sinks.
I'm struggling to reconcile something here, though. Let me push back on this idea of a narrow market being inherently dangerous.
Sure.
If the major indexes are still so high, doesn't that just mean those few mega cap companies holding it up are simply that strong? I mean, if the titans are winning and they make up the bulk of the index's weight anyway, why shouldn't the index just keep winning alongside them? Why is this specifically a warning sign?
It's a fair question, but historical market mechanics dictate that the titans cannot carry the market indefinitely. Eventually, the exhaustion spreads. The historical precedent documented in the models is incredibly clear on this point, actually.
Okay.
The index catches down to the internals. The internals do not magically catch up to the
Oh,
index.
wow. Okay.
Yeah, when breadth collapses this severely, it signifies that the underlying liquidity driving the broader market is drying up. The giants hold the line for a while because, passive investment flows blindly funnel money into them.
Right. People just buying the S&P
Yeah,
automatically.
exactly. But as the smaller components break, the margin calls and portfolio liquidations eventually drag the giants down too. In fact, the models specifically mirror this exact setup to the really dangerous market of Q4 2021 heading into Q1 2022.
Right. I remember that.
Yeah, the surface looks perfectly fine right up until the floor falls out.
So if the underlying foundation of the market is rotting away like that, and history points to a sudden drop, you would expect the institutional players to be in full-blown panic mode.
You'd think so, yeah.
But they aren't, at least not visibly. I am looking at the VIX, what everyone calls the fear gauge of the market, and it is practically asleep, sitting at just 16.06. How do a collapsing market foundation and a complete lack of measurable fear exist in the same reality?
Well, the AI synthesis flagged that exact contradiction as volatility mispricing. We are essentially witnessing a calm surface masking deeply stressed plumbing.
Stressed plumbing.
Yeah. The VIX hovering at 16 is super misleading because the VIX only measures the demand for short-term, at-the-money options.
Okay.
It essentially measures normal, everyday hedging, the kind of routine insurance you buy for minor fluctuations. To spot real institutional panic, the models divert our attention to the skew index.
And the skew is highly elevated, right? It's sitting up near 136.86.
Exactly. The skew measures the demand for extreme tail risk hedging. We're talking about black swan insurance here. When the skew spikes that high while the VIX remains low, it means the largest players in the market are aggressively but quietly buying protection against a catastrophic multi-standard deviation drop.
While just completely ignoring minor day-to-day fluctuations.
Precisely.
So it's like everyone is sitting on the beach enjoying a sunny 75-degree day, but the billionaires are quietly buying up all the hurricane insurance in the background.
That is a perfect way to put it.
They aren't running around screaming, but they are absolutely preparing. What about the credit markets, though? Usually when things go bad, junk bonds collapse, right? Is that happening?
Well, actually, if you look at the synthesis, high-yield credit, HYG, is doing fine. It's sitting around 79.68, down only a fraction. Spreads are tight.
So no panic there.
Not visibly.
Right.
But the models warn that credit is always the last shoe to drop in a late-cycle regime. Equities will mask the rot, and companies can often keep rolling their debt over right up until the moment liquidity just completely vanishes. Yeah, plus, if we connect this to the bigger picture, the commodities dashboard reinforces this narrative of stealth preparation. Look at gold.
Oh, yeah. Gold, GC, is surging near an eye-watering $4,494.20.
Right. Gold catching a massive safe haven bid while the traditional stock market fear gauge is simultaneously asleep. It's a classic sign.
It feels incredibly contradictory.
It is a textbook signature of smart money hedging. The models call this pre-event volatility compression. Institutions know the foundational rot is present. They're securing their life rafts.
So if the smart money is hiding in gold, buying extreme tail risk insurance, and just waiting for credit to crack, what is actually causing this fragility behind the scenes?
According to the synthesis, it comes down to two forces colliding: draining liquidity and returning inflation.
Okay, let's start with liquidity.
Yeah, the models break down something called the liquidity illusion. Over the past few years, the market has been artificially kept afloat by massive hidden liquidity cushions. One of the most important is their reverse repo facility, or RRP.
Which acts like a holding tank for excess cash.
Exactly. But today, that holding tank is drained nearly to zero. The cushion is gone.
Right. And here's where it gets really interesting. I was looking at the Treasury General Account data, the TGA, and it is rising.
Yep.
The TGA is basically the government's checking account, right? When they issue new debt to fill that account, it physically pulls cash out of the private financial system. So the TGA rising is a stealth tightening measure.
It sucks oxygen directly out of the room.
Combine that with the fact that M2REL, the actual money supply adjusted for inflation, is completely flat. And you realize real spendable liquidity is simply not expanding.
And the timing of that liquidity drain is brutal because it is colliding directly with a surge in macro pressures. The dashboard highlights oil running incredibly hot. Brent crude is at $96.72, and WTI is at $95.13.
Pushing your $100 a barrel?
Right, and the models attribute that to geopolitical premiums, specifically rising U.S.-Iran tensions. But from a pure economic standpoint, oil near $100 creates a massive inflationary impulse. It bleeds into everything.
Which instantly hits the bond market. Because inflation is running hot again, bond investors demand higher yields. So now we've got the 10-year Treasury yield sitting uncomfortably high, right around 4.46%.
Exactly. Which leads to this brutal conclusion from the AI synthesis. The Fed cannot cut rates in this environment. In fact, there's a real risk they may have to hike in 2027 to fight off the returning inflation.
A rate hike in a market starved for liquidity. That's terrifying. But wait, let me push back on the currency side. The US dollar, the DXY, is actually softening today, which usually provides a nice tailwind for US equities.
Normally, yeah.
But when you look at the USD-JPY, the dollar against the Japanese yen, the dollar is incredibly strong, hovering around 158 to 160. Doesn't a softer overall dollar help equities? Why is this specific pair an issue?
The models flag this divergence as a massive macro anomaly. It comes down to the carry trade.
Yeah.
Institutional investors have been borrowing Japanese yen for years at rock-bottom rates, converting it to dollars and buying higher-yielding U.S. assets.
Oh, right. Free leverage.
Right. That trade is technically still on, providing life support to the U.S. market.
Yeah.
But at 158 to 160, it's entering a really dangerous intervention zone. The Japanese government can't tolerate it much longer.
So if they intervene to strengthen the yen, the math on the carry trade blows up.
Precisely. Investors would have to rapidly sell U.S. assets to pay back the yen loans. The liquidity supporting our market is incredibly fragile right now.
Okay, so with inflation returning, liquidity draining, and the broader market crumbling under a few mega caps, how does an investor navigate this? We need to know exactly which companies survive this regime change and which ones get crushed.
The synthesis is very clear on the map of winners and losers. They categorize the most vulnerable as Tier 1, structural losers. These are assets with severe duration risk or impairment.
So we're talking regional banks, right? Hurt by commercial real estate and shrinking that interest margins.
Exactly. And office REITs are in the same sinking boat. Plus, unprofitable tech companies, specifically AI and RK-style names.
Anything that promised profits a decade from now. That explains crypto bleeding today too, right? The dashboard shows Bitcoin down over 4% to 62,855.
Yeah, that duration risk is toxic right now. Oh, and legacy autos like GM and Ford are also structural losers due to massive CapEx needs and margin compression.
But on the flip side, we have the survivors. All 14 AI tabs agreed on a handful of companies they label elite compounders. These are businesses with true, undeniable moats.
Yes. ASML is the perfect example. Sitting at 1726.36 today, they have a literal monopoly on EUV tech. You physically cannot manufacture advanced chips without them.
And KLAC is having a huge day, up nearly 4% to 2125.1114.
Right. They own the metrology choke point. If you want high chip yields, you have to use KLAC. Other tech moats in this elite tier include Synopsys and Cadence for chip design, Microsoft for AI infrastructure, and Meta, which is flagged for massively undervalued free cash flow.
Makes sense. What about the macro winners?
Defense contractors like LMT and NOC are catching geopolitical tailwinds. And obviously, energy giants like XOM and CVX are capitalizing on the oil regime. The energy sector ETF XLE is one of the few green spots on the board today, up 1.29% to 58.71.
Okay, the tech monopolies and energy giants make intuitive sense, but I want to zero in on a surprising name on this winners list. Waste Management, ticker WM, currently sitting at 200.
Oh, that's a fascinating one.
So what does this all mean? I get why ASML is a tech monopoly, but why is a garbage collection company in the exact same elite tier as Microsoft?
It comes down to what the AI calls local monopoly economics. In a late cycle, high inflation environment, true pricing power and an inescapable physical moat are exactly what survives a regime change.
Right, because you can't just build a new landfill in the middle of a major city.
Exactly. The zoning, the regulations, it's impossible. So when inflation drives up their costs, Waste Management just raises their collection fees. Customers have no choice. The garbage still has to go.
That is brilliant. True, unyielding pricing power. Okay, as we wrap up this deep dive, I want to ask you for the ultimate allocator grade bottom line from the source document.
I'll give you the single unified sentence the AI models produced. They concluded, "The market is in a late cycle, liquidity-supported, narrow leadership rally with collapsing breadth, rising macro pressure, stealth hedging, and a growing probability that the index will correct downward to match deteriorating internals."
Wow, that really drives it home. Don't be fooled by the shiny surface of an index hitting all-time highs when the internal engine is sputtering.
Right, and this raises an important question to leave you with.
Okay, what is it?
If the entire market's stability relies on just a handful of elite compounder stocks to hold up the index, what happens to your portfolio on the day those specific titans finally decide to take a breather?
That is the big question. Look at your own holdings. Are you relying on the index's illusion, or do you actually own the moats? Thank you for joining us on this exploration of the market's hidden gears. Keep a close eye on those internals.